Hey guys, we're doing our weekly market update for the housing market here in the Phoenix area and a little bit around the country. And we've got a lot of really exciting news this week. For those of us who like to know what's going on with the market, so I'm going to jump right into my screen here. And I'm going to really try to keep this simple because there's really not a whole lot to it, just understanding kind of how things work. But consumer inflation falls below key milestones. So we see year-over-year inflation is down, which we've been talking about. Um, we see that overall inflation has been going down. That's going to help us with interest rates for what the Fed looks at. But more so, we're going to talk about jobs and what's going on there, plus what Jerome Powell said today and what the bond market is doing, which sets all these mortgage rates and stuff. So home builders have mixed emotions. They're not really sure what's going on, and buyer traffic's down. Well, we've had this sustained period of time where prices pretty much doubled and then interest rates more than doubled, right? But they're down now, they're trending down, which we're going to talk about. But builders right now are offering all kinds of incentives. So, guys, so are home sellers. So, right now, guys, again, if you're a buyer, let's talk, please. I'm begging you. If you need to move or you can afford to move, please let's talk, please. Not because I'm going to try and talk you into doing business, but because right now is when you can get the best deals, not just on price, but on rates negotiations for the seller to pay to buy them down. Okay. Or the builders to buy them down. And these are move in ready homes in a lot of cases for the builders. Okay. Also, there's an investment aspect there because as rates trend down, builder prices are going to go up faster, seller prices on resales are going to go up faster. And if I were you, if I unless I really, really, really needed every dime to move, I would even sell and buy, if that's what I'm thinking about doing, to move on to my next property where I can gain the equity in the property I want to move to. Okay, so I would move now because this is the beginning of a rate decline cycle. Okay, rate reduction cycle. And it does not matter. I repeat, guys, I'm gonna go big screen on you here for a second. It does not matter who gets elected. Why? If one side who you think is going to destroy the economy destroys it, interest rates go down and housing does well when there is a recession. 2008 was an anomaly. We're not in 2008. We don't have the loan programs that are garbage. We don't have the quadruple the amount of inventory that we were dealing with then, and a lot of other economic factors, and people's equity was nowhere near what it is now, and blah blah blah. Okay, we talked about those things a million times. If so all those all those ideas, all those things are out the window. So, and if the other one goes in, well, let's just say we know what happened there. Okay. Now, why were rates so super low during COVID? Because that was a recession. During every recession, okay, there was one housing recession. Okay, one housing recession. Property values go up over time. Okay, that was a housing recession. In 2008. For COVID, they went down to those anomaly numbers primarily because we were in a recession. Okay. Plus, yes, the Fed was juicing the market with all the extra funny money that was being injected to keep the economy going. Otherwise, we would have had a Great Depression with everything shut down. So, kind of had to flood the market with some dollars back then if you were going to shut the economy down. But that said, during every recession, housing does well. Housing actually brings back the economy because rates drop and then people go out and they invest in homes. You could I've shown the charts a million times. I'm not going to do it now, but so guys, doesn't matter who gets elected. I repeat, it doesn't matter who gets elected. We're trending in that cycle right now. Okay, what could destroy the economy is something I heard this week about price fixing houses, which that's what they do in communist countries. So I hope we're not doing that. Um, but opening up government lands, opening up supply lines, and getting more inventory availability, less regulation, those things are going to bring back the housing economy and lower interest rates over a sustained period of time. Okay. It's not that complicated. We talk about this every time. It just, I keep hearing all these other things. Now, all these other ideas that they have about, oh, the tax credits, and we're going to, now if you're giving people down payments, that money comes from somewhere. That's another idea here floated from one of the people. Hang on one second. Puppy's making noise with his bone. Okay. Um, that's going to be an inflationary factor, guys. If every homeowner can get access, or first time homeowners or whatever, certain income levels can get this $25,000 towards their down payment, that money comes from somewhere. It comes from taxpayers, or it comes from print and funny money. That's an inflationary factor. We don't want that. Tax credits, tax cuts, those could work if they're set up properly to help. That would help a little bit, but that's not what we're looking to. That's not what really is going to solve this. What's going to solve this is the Fed, which they're finally doing, getting on board with lowering the rates. The bond market's going to react first. They already are. And getting into back to reality on where things need to be and stop being slow and old Jerome Powell. I think he's finally getting it there. Because today he did his Jackson Hole symposium speech. So in any case, this will be solved. This new inventory that's really from new home builds. This will be solved with allowing them to build more homes by feeling like they can actually do that and make a profit and not overbuild. Okay. So, the other thing was I just talked about was Jerome Powell and Jackson Hole. In a nutshell, he's saying, yeah, I think we may have to accelerate this. The big news this week that went along with that, coupled with that, was U.S. added 1,818,000 fewer jobs than thought, adding to concerns about the economy. That comes from the Bureau of Labor and Statistics. That's from the government entity that watches this through the way they track this, which, is a whole nother story, but they have adjusted these numbers, and this is where we're at. So you have the jobs claim going up just recently to 4.3%. That was what we were looking for. If that goes up even more, we're going to see an accelerated path for the Fed that's already going to be reducing originally at probably 25 basis points. But if that goes above that 4.3 again, and that'll be coming out, let's see, jobs report will be September 6th for the August jobs report. Their meeting, the Fed's meeting is September 18th. So those are the key dates to watch, because if it goes up above that 4.3 mark, I think we're definitely going to see, if not already, them accelerate to maybe a 50 basis points instead of 25 basis points drop. The market is already pricing in, the bond market's already pricing in 100 basis points this year and 125 basis points for 2025 for next year. Again, anything can happen, anything can change, this, that, but that's the path we're on. Okay. That's where the models are. So basically, Jerome Powell starting to see the light. We kind of knew these numbers were off, that we kept getting. It's finally caught up. We told you about this, was going to catch up eventually. Those jobs numbers were going to be, showing a little bit softer jobs market. We actually, again, we're not rooting for people to lose their jobs, but we want accurate information about what's really happened in the job sector. We weren't getting it. So between that, the quits ratio, people quitting their jobs, salaries, where they've been, when you look at, what these jobs really are, are they really, high powered, high dollar jobs, most of them, that we are getting, and all those sorts of things that we've talked about before. The answer is that it's softening. And I told you, every recession starts with housing or construction. So we saw last week, I think I mentioned this to you last week, Home Depot showed that their sales were down, sounding the alarm for rehabs and stuff were down. Um, Also, we see that there are about 45,000 construction workers that have now, in the newest data, lost their jobs. Okay, so that's not something that's just going to bounce back, not with the way things are right now. But I think the housing economy generally overall is what's going to save this economy and bring back, the economy. So the 10-year treasury is what we track in, big time, as far as where we're going to be on the mortgage rates. Usually that should be about 1.75 to 200 points difference between the 10-year treasury and where we are in mortgage rates. So we'll see where we are in mortgage rates today. The splits between the 10-year treasury and mortgage rates on the overall averages are getting better. You can get better interest rates with less in pricing and costs with a mortgage broker right now today by about 50 basis points from what I'm seeing. If you bought in the last year or two, you want to talk to somebody about refinancing. If you're going down 25 to 25 basis points, every time it does that, about or every 6 months as it goes down, you want to refi. Why? You're going to save money. Okay. It's as simple as that. um but Chris, it restarts the loan, but it lowers your payment. Now you have extra money to do whatever, savings, invest in other things, pay down your principal if that's what you want to do. All the sorts of things, you gives you more options. So um this is what we track. That those splits are getting better though, and that will automatically get us, between a 10-year treasury and a mortgage rate, get us better. And right now, again, guys, I'm seeing 1.9% first year on these buy down rates by builders. Sellers are also offering them 3-2-1 buy downs. Basically, just think of it as, first year, my interest rate's 3% lower than what it would be today, basically, in a nutshell, using round numbers. Okay. Uh, yeah, yeah, that much lower. So some builders are offering in the ones, they're paying it down that low. Okay. Uh, First year, yeah. But Chris, does it keep going up? It goes up for the first 2 or 3 years, possibly 4, depending on how it's structured, and then it stops. So it's going to stop in most cases around 4 or 5%, or they're offering just straight, you know, 3.9%. I've seen 4.5, 4.9%. So much lower than what the national average is, or what you're going to get just with a straight deal. Those are from builders, also from sellers. Okay. So I repeat, you can get lower rates now. Okay. I don't know. It just doesn't seem to compute, and people want to wait because if you wait, what's going to happen? In other words, we can negotiate this now better than price on a $10,000 price reduction. Right now, you're going to save about 78 bucks. But on a rate buy down of 100 basis points or 1%, you're going to save almost $250 on an average home price right now. On the average home price, you're going to save about $250 a month. Hello, 78 or 250? Which do you prefer? Okay, pretty simple stuff, guys. So if you're thinking about buying, again, if you can't afford it, you can't afford it. If you don't need to move, you don't need that extra money, okay, maybe. But just keep in mind, everyone's going to run into more competition, whether they're selling, whether they're buying. Okay, you're going to run into more competition, less in the way of buying down rates, less in the way of closing costs being paid for, less in case of reduction in prices when there's more competition, which will come with lower interest rates. Hello, am I getting through? Okay. Sorry, guys. I just want to. It's like, again, I kind of use this example. Everybody's like, man, I wish I had bought stocks in Apple when, or this company or that company when it started. I'd be a million billionaire right now. Well, I'm not saying you're going to necessarily be a million billionaire by buying a house. Although, the average renter compared to the average homeowner is 40, the homeowner is 44% wealthier right now. The average homeowner has $300,000 in equity right now. Over 40% of people who own a home own their primary home outright. You do the math. The 2-year Treasury, about much more volatile, kind of more of a look, but this is also, now that we're sub 4, again, another indicator we're baking in these big rate reductions. And the bond market's going to react before the Fed does. So does the Fed set the interest rate, the mortgage rate, or does the bond market? Well, really, it's the bond market. The Fed certainly influences it by what they say and then by what they do, because they usually say it first. And they kind of, but the bond market reacts to more of what is going on in the actual economy, in the market, with unemployment, with inflation. Okay. With the way things are going in the economy and the markets overall. So mortgage rates fall to 2-week lows. Yay. Awesomeness. Mortgage rates, as far as, these are the average across the country. Take them all, lump them together. These are the averages with no rate buy downs, no more, not really working with the mortgage broker, looking at basic retail rates out there. Why would you pay retail? There might be a few circumstances in where you might, but I always like to kind of make sure people have a look at a mortgage broker, or if they're buying a brand new home, what incentives the builder is offering, and you can always refi later. In any case, these are just the quick look at the numbers. I don't want to spend a lot of time on this, but we're at 3.75 month supply. Again, we're in a balanced market. Absorption rate, it's actually down a little bit. Sorry about all the noise with the dog moving around. I'm doing this from home today. The average sales price is $558. Okay. So that's the average sales price. The average list price is $729. The list to sales price ratio is 97. That's a little lower than we like to see. Nothing crazy in any new inventory, which we know because the builders permits are down. They're not really building in, super fast like we'd like to see to handle all the demand that we still have in the markets. Remember, we have a lot of people moving here from out of the country too right now. Just saying, that's going to put whether it be the rental market, whether it be purchases, that puts a strain on demand. Okay. So people are wondering, well, how are people doing it? How are prices still going up overall? Even though things may be flattening out in certain areas or whatever temporarily. Well, you got 2-income households in a lot of cases. You have people, like I said earlier, that have all that equity that kind of pads that they can maybe even pull from if they needed to in an emergency, or get a HELOC or whatever product, that may help them out temporarily. They, over 40% of them own their homes outright, so there's a lot of factors there. And then you have pending home sales down a little bit, closed units down a little bit. Again, some of this is just the season. People are back in school for the greater Phoenix area. So things kind of slow down a little bit, guys. And that's, most of the inventory is under 600,000 as usual. So, nothing much has really changed there. Nothing in great, look at the percentages. Oh, the percentage has gone up in some of these distressed things. Not all of them, but some of them. Okay. But the actual numbers, you got to look at the actual numbers. We're not seeing a ton of foreclosures or short sales or whatever. That's minuscule number when you look at it. Oh, there's 18,000 homes for sale. Again, during the crash, look at 18,000. During the crash, we had about 56, 58,000 homes for sale here in the greater Phoenix area. We're nowhere near that. There's not enough supply to go into a crash. We're not going into a crash. And a recession in the economy does not mean housing is going to do bad. It means the actual opposite. Okay. All right. Cromford Market Index tells us what we just said on the other chart. We supply and demand are almost the same number. We are, under 90 is a buyer's market on this chart, and the index over 110 is a seller's market. During the crazy market that we were in a couple of years ago, 2-3 years ago, we were at this number was at in the mid to high 4s, even close to 500 or in the 500s on any given week. So that's the difference. over 110 in that seller market. We are in a completely balanced, neutral market right now. Of course, certain neighborhoods, other areas, da da da. Always, real estate is always hyper local, um, but this is kind of the way it is, kind of across the country. And a lot of the inventory, again, that we see coming on the market are coming out from Texas or Florida. But we are 27 points low on supply and 27 points low on demand. Okay. Uh, Fountain Hills tops the chart for cities proper on the index, up 12%, as coming in at 175 on the Crawford Market Index as a seller's market. So a little bit of a advantage there in Fountain Hills. Also Chandler, but that's down 12%. So Chandler was topping the charts for quite a while. Then Avondale's at 152, Scottsdale at 130, Phoenix proper is at 126, Mesa 120, Glendale, Gilbert, Paradise Valley. Those are all in sellers markets. Paradise Valley is at 111, so barely seller market. Peoria is at 105, so that is a balanced market, along with Tempe at 99. And then Cave Creek is also in balance at 97. And then below 90, we have a buyer's market, which would be Goodyear topping that chart at 87, then Surprise, then Maricopa City, Queen Creek, and then Buckeye, the greatest buyer's market in the area right now at 66.4 on the index, but actually up 10% on the index. So there you have it. Buckeye is your best chance for getting a good deal on a purchase. And if you're selling a home, Fountain Hills tops the chart for a seller's market. Again, if we're looking at the contract ratios, which kind of give us even more detail into the now of the market, even more than the Crawford Market Index, everything's kind of warm to cold right now. Again, part of that is the cycle of the season. School just went back into session, so our spring and early summer's over right after the holidays. That all that's over now, so things do slow down. They will pick up a little bit after Labor Day, especially in retirement communities where we have our winter visitors come in, or second home owners that want to get out of the cold but have the more moderate temperatures here in the valley. So they'll be here for the retirement communities or people that visit, but and have these second homes. But so those are usually popular again for sales and purchases in the fall and winter. But right now, Phoenix, a little bit in Phoenix, South Phoenix area, little spot in Glendale, and a little spot in North Peoria area up by the 101 up there. But other than that, those are kind of hot to warm. Other than that, everything's kind of warm or cold, guys, or freezing right now. So after Labor Day, things will pick up in general a little bit more than right now, only because not only that retirement community stuff, but you do have some serious buyers that maybe didn't get what they wanted earlier in the year or couldn't buy earlier in the year. They're going to look right up until the holidays. And you still have some people looking during the holidays. So you get serious buyers that are searching around that time. Those are serious people. And then right after the holidays, we go right back to it. So guys, that's my report for this week. I'm going to be putting out some other videos this week. We're going to talk about some other statistics. I did mention to you also, there are some new NAR rules right now. Basically, we can't put compensation in the MLS. Those things have always been negotiable anyway. To go out to look at properties with a realtor outside of walking into an open house, right now, the way it stands anyway, you basically have to have some sort of written agreement with a realtor to go look at those properties. But Chris, who pays these guys now? Well, just like it always has been, and we've been doing this since 2012. where, we sit down with somebody, do a consultation, go through what it takes to purchase a home, things to know, kind of the process, make sure they're pre-approved for a home loan if they need to do that, or have proofs of funds for cash. And then, we have a buyer broker agreement. They're hiring West USA Realty. We're the agents of West USA Realty with the Mincola Group. But they are using, we have an agency form that basically shows we represent you. Kind of like an attorney, we practice limited law when it comes to the purchase contract. We're not, a lot of people have this idea of professional door openers. Those realtors were out there, they're going to have a hard time with this kind of market, because they were professional door openers. But when you kind of have more of a pro approach to the whole real estate, process and industry, you're going to have a lot of the pros left in the industry doing these sorts of things. So, you're going to have you have to have a signed agreement. That's like law and what brokers are going to require, across the board pretty much. So, that's they do have a tour form or buyer broker form. Honestly, we just like to do, even if we have to do a short buyer broker, just to keep everything clean and neat and across the board, up on the up and up with the agency level. That just, basically shows that we're going to work for you. If we do put an offer in, those commissions on our end can be negotiated by the seller. And depending on what that offer is, we'll be able to negotiate that in there. And that's been going on for years, is even with not only single family homes, even though before it was required that you had to have even $1 on the MLS field, that field has been totally taken out and you don't have to do that requirement anymore. Now for sellers, it actually works in maybe a negotiation. It gives you a little bit like, hey, I'm not telling you what I'm willing to give. I'm not telling you how low I'm willing to go on any offers, right? Or what terms I may or may not take. Send me the offer, I'll take a look at it, and we'll go from there. Kind of close to the vest type negotiation. So from that standpoint, it can be good. But, I kind of look at things, I like to have options. Um, so personally, from the standpoint of having that field there, I think it should be something that's optional, but that's just my opinion. If you want to ask my opinion, I've had a lot of people ask my opinion. Also, if a seller feels like, especially in this climate where you hear a lot of misinformation, well, this is going to reduce prices and you don't have to pay realtors anymore. None of that's true. None of it. I don't care who said it, from what political campaign. It's not true. So, people usually don't work for free. And so that's that. So, and there are, again, there are the professional door openers compared to the people who really take this as, serious consultation up front, serious about, getting you top dollar for your home, that are really going to work beyond just putting it on the MLS, all those sorts of things. But that field's been taken out, and there has to be written agreements, whether it be seller or buyer. And like we've always told people, if for some reason the seller is not offering a commission, okay, then we do need to figure out how we're going to get paid. So then at that point in our agreement, that percentage that we were trying to get would be something that we would go through with them, up front. So it's clear that if you want to go see that house, put an offer on that house and be represented by us to get through the process, to get through the contract stuff, to be protected that way, and not go to the seller who's got a seller's agent that's protecting the seller, not you. Okay. They're not representing you, they're representing the seller. They're going to take full advantage of that too, trust me. And they're still going to get, probably in most cases, a higher percentage, because they're still representing the seller, or in some cases maybe trying to do a dual agency, which we try to steer away from. But suffice to say, they're going to get a higher commission, or maybe someone else in their brokerage is going to also represent you, which is a dual agency. That means the same agency is representing you both. Not always the best idea. Attorneys would cringe at that, and rightfully so, in my opinion, although it is allowed. But be smart out there, guys. You don't want to go to a courtroom. You don't want to go into a courtroom unrepresented. And as far as what people charge, those things are always negotiable. But I will say this: when you go into an airplane for a flight, do you want the person who's paid the least, or do you want the person who's paid, higher on the scale, or paid the most because they've earned it? Okay, um, because they're going to get you where you need to go in the best, smoothest way. Okay, um, you know that's it in a nutshell. I could go on and on about those things, but sometimes we want to save a buck, but we end up stepping over, dollars to get the pennies. So there's a lot of moving parts, and I hear people all the time. I can do this. All the information's out there. Yeah, there's a lot of information out there. There's so much that it can be confusing, number one. And number two, there's a lot of bad information out there and a lot of misinformation out there. And whether I've in the past have worked with renters, sellers, or buyers, time and time again, we see people who are taken advantage of. So be careful what you sign, be careful what not being represented, and be careful with who you're working for. Make sure there's somebody who really, really cares, who really, really wants to make sure that you're well taken care of. All right, guys. If you have any questions at all, feel free to reach out anytime. We're here to help with any questions. Thank you so much. We'll talk to you next time.